In mid-March, the ECB pivoted. Officials turned hawkish. Energy shocks from the Iran conflict were pushing eurozone inflation toward 3% above target. Markets heard a clear signal: rate hikes are coming. But here's the shock: the ECB is tightening while the Fed loosens. That transatlantic split is about to reprice the eurozone banks, and global capital flows. And Europe is not ready. March 19, 2026. Inside the European Central Bank headquarters in Frankfurt, the mood snapped. For 2 years, the talk had been about cutting, easing, supporting, getting growth moving again. That morning, the language flipped. Officials shifted to a hawkish tone, and Christine Lagarde, the ECB president, told reporters it was too early to act. But the bank needed to assess the nature, size, and persistence of the inflation rise. Translation: rate cuts are over. Rate rises are back on the table. The trigger sat on every dashboard in Europe. Eurozone inflation jumped to 2.5% in March, up from 1.9% in February, driven almost entirely by energy. That single jump matters to anyone filling a fuel tank or paying a heating bill, because every basis point the ECB moves changes what your mortgage costs, what your job costs, what your savings earn. The deposit rate has sat at 2% since July 2025, the floor after 200 basis points of cuts. Holding there was meant to be the start of a recovery. Money cheaper, factories humming, hiring resuming. Instead, Frankfurt is staring at the opposite problem. According to the data we reviewed, the risk of a rate rise later in 2026 is high if energy-driven inflation seeps into wages and services. The next move could be up. We'll see exactly what flipped Lagarde's hand. That trigger was the Strait of Hormuz. Watch the orange line. Inflation crashed from 10% in 2022 down to 2.2% last year. Then it bends back up. The eurozone now averages 2.4% in 2026, Germany hits 2.7%, and August could spike to 3%. The war in Iran shut the choke point. Europe's energy bill paid the price. The disinflation path resumes below target by 2027. While Frankfurt sharpens its pencils for a possible rate rise, Washington is going the other way. The Federal Reserve holds at 3.5 to 3.75%, already 75 basis points lower than a year ago, after cuts in September, October, and December 2025. According to the data we reviewed, the Fed plans just one more cut, 25 basis points in the fourth quarter of 2026, taking the range down to 325 to 325. The ECB, holding at 2%, with hawks in the room arguing the next move is up. That leaves a gap of 105 to 105 basis points between the world's two biggest central banks. And that gap matters more than the numbers suggest. Anyone holding euros or dollars watches it closely. The mechanism is brutally simple. Capital chases yield. When American rates sit nearly 2 full percentage points above European rates, money flows toward the dollar. When that gap narrows, because the Fed cuts and the ECB does not, money flows back. For 3 years, the spread punished the euro. In 2026, for the first time, that arithmetic is reversing from the European side. The euro is about to do something it has not done in a long time. And the consequences land first on the country that exports more goods than any other on the continent. That something is climb. Through the second quarter of 2026, the euro averaged $1.17 against the greenback, and the data points to a full-year average of $1.18. By 2026 and 2027, analysts project that level holds. Sounds technical until you trace what it does to German factories. A stronger euro is a punishment tax on German manufacturers. Every Mercedes, every Siemens turbine, every BMW priced in dollars suddenly costs more for American buyers. The exporters who powered German growth for 2 decades, chemicals, machinery, autos, get squeezed twice. Once on the rate side, as borrowing costs may rise, and once on the currency side, as their goods get pricier abroad. On the flip side, that same strong euro makes imports cheaper. Brent crude priced in dollars stings a little less when your currency buys more. Heating bills, food imports, machinery components, all a touch easier. So consumers win, modestly. Factories lose, painfully. And the trade surplus that has been Germany's economic identity since the 1960s, the world's largest source of high-end manufactured exports, gets thinner. A country built on selling abroad now has a currency working against it. But the deeper damage from a tightening ECB lands further south. Berlin can absorb a stronger euro. Rome cannot absorb wider spreads. Look at the spread. In September 2022, Italian borrowing costs sat 251 basis points above Germany's, a panic. By January 2026, that had compressed to 64.6, a multi-year low. May 26, it widened to 72. Still small versus the crisis, but the direction has flipped. Every basis point wider adds millions to Italy's interest bill. And Rome's debt clock is ticking against an ECB that may hike. "72 basis points sounds abstract until you ask who pays. The answer fans out across Europe in unexpected ways. Start in Dublin. The data we reviewed flags Bank of Ireland, Allied Irish banks, and Permanent TSB as the most rate-exposed lenders in the eurozone, because their loan books lean heavily on corporate borrowers, and corporates operate on tighter margins than households. Hike rates and demand for business credit dries up fast. Profit forecasts get rewritten. Now, jump to Tallinn. Estonia is the mirror image. Nearly 9 in 10 mortgages there carry variable rates. When the ECB moves, every Estonian homeowner feels it the same month. In the short term, that is a windfall for Estonian banks. Wider net interest margins almost overnight. In the medium term, it is a default risk waiting to happen, because families do not get a raise just because the central bank changed its mind. Across the rest of the eurozone, banks expanded their margins enormously during the 2022 to 2024 tightening cycle. Then watch those margins compress through 2024 and 2025 as the ECB eased. A return to tightening flips the arithmetic again. Winners and losers reshuffled, depending on whether your customers are corporate or retail, fixed rate or variable. Geography decides the wallet hit. But there is a much bigger balance sheet at risk than any single bank's. That balance sheet belongs to Europe itself. The ECB sits in front of a choice with no clean exit. Tighten further, and Italian spreads keep widening. On a debt stock near 2.9 trillion euros, every 100 basis points adds roughly 3 to 4 billion euros to Rome's annual interest bill. Hold too long, and energy-driven inflation seeps into wages and services. The moment a price shock stops being temporary and becomes structural. Lagarde knows this. Every governor in the room knows this. The deeper trap is that the Fed-ECB split itself is reshaping the continent. A strong euro punishes German exporters. A hawkish ECB punishes Italian borrowers. A widening rate gap pulls capital one way, then the other. Each move solves one problem and creates another. This is what a constrained central bank looks like in real time. The story that started on March 19 in Frankfurt, when officials swapped easing for hawkish caution, runs through Berlin's factories, Rome's bond auctions, Dublin's loan books, and Tallinn's mortgages. 5 countries, 5 consequences, traced back to one room and one decision. The numbers we walk through say the same thing in different ways. The eurozone is no longer in a recovery cycle. It is in a balancing act. And the open question for the rest of 2026 is simple. Who pays when Frankfurt acts? The ECB must tighten to anchor inflation. Whether the eurozone can withstand it is the real risk. Like, share, and subscribe. See you tomorrow.